What I'm going to talk about today are some of the drawbacks that I see when it comes to getting a whole life insurance policy for cash value. And often what happens is individuals get a life insurance policy, they really want their cash value maximized, and expectations are just not set properly. I'll go through exactly what that means. Let's start with the first drawback. When you get a whole life insurance policy, especially if you're getting it for cash value, the first year is the worst year. This is going to happen every single time you get a whole life insurance policy. And the reason why is because the expenses or costs in a whole life insurance policy are heaviest up front. What you will see is that it always takes time to grow the cash value. So let's look at a couple examples here. We'll start with a traditional whole life insurance policy, which if you've ever looked at whole life insurance, it may look similar to this. This is on a 35-year-old individual. And what do you notice? In red, he's paying what? $20,000 per year. That is his base premium. In purple, you see the words PUA rider. PUA stands for Paid Up Additions Rider. This is the key to growing the cash value quickly in a life insurance policy. And then the annual funding represents the base premium plus the PUA rider column. So the annual funding is what? It's just the base premium. So this is a traditional whole life insurance product where we see $20,000 paid. It all went to the premium. And as a result, his first year cash value is what? Zero. How about the second year? Not good at all. $700, and he's paid $40,000 at this point in time. When you look toward the bottom at year 14, you'll notice that it's highlighted in yellow, $280,000. What is that? That's how much money he's paid in, and this is his break-even point. What that means is he ran a loss for the first 13 years of the policy. And at the end of the 14th year, he finally has a gain. Would you consider that an attractive place to put money? Probably not. Not attractive at all. So how do you make that better? Well, we talked about the two areas money can go, the premium or the PUA rider. So what we're going to look at next is on the left, the exact same policy. Then on the right, what do you notice? Well, now we've got a policy where your out-of-pocket is exactly the same. So you're still paying $20,000 per year. The difference is now of that $20,000, how much is going toward the premium? $7,000 instead of $20,000. How much is going toward your PUA rider? $13,000. Add the two up, $20,000 total. Same product here. Now instead of a zero in the first year, you've got $12,000. And again, with the same product, instead of taking 14 years to get your money back, you get your money back in 9 years. Much more attractive, isn't it? Now, would you want this? It's an $8,000 loss in the first year. I wouldn't. Here's another step. On the left is what we just looked at. There's your $7,000 minimum premium. But then to the right, what do you notice here? Well, now your minimum premium is at $2,000, and the rest is allocated toward the PUA rider. So what's going on here? We are reducing the premium and putting more money toward the PUA. What that does is give you more cash value up front, an earlier break-even point, just about year 5 in this example, and more money long-term as well. So what we're doing is just redirecting where the money is going to give us more cash value in the same life insurance policy. Make sense? And then there's other options and strategies you can exercise. For example, here's the same product, but with this option, what do you notice on the right? You've got more money up front. And if someone said, hey, I don't want to pay into this for 15 years, that just feels like a long time for me. Can I put it in faster? The answer is yes. Look at this. There's our minimum. There's our annual funding, a big lump sum up front. Breaks even year 3 in this example. and then it just keeps on compounding afterwards. My point is, we can accelerate the cash value of a life insurance policy by designing it properly. But with all of those options, did you see any of them that had a positive cash value in the first year? No. Here's the best one up front. You've got 92% of what you paid into the policy available in the first year, which goes back to the first drawback we just hit on. The first year is the worst year. It takes time for the cash value to grow. How you overcome that as much as possible is by reducing the base premium, reducing the insurance expenses, and getting more money into your PUA rider. That's how you accelerate the cash value growth and minimize the hit of the first year. Number two, cash value under delivers. So this is a big problem in the life insurance industry. What this means is you may get a policy and an illustration, which is what we just looked at. That might show you $1 million 20 years from now. However, when 20 years actually comes, your actual results are only $700,000, meaning the policy under-delivered compared to what you thought it would actually produce for you. I was told I would get $1 million. I end up with $700,000. Who wants that? No one. So how we overcome this, because this is a big problem in the industry, there's two things you can do. Number one, what we just talked about earlier, design the policy appropriately, where we've got a minimum base premium. When we do that, we see stronger guaranteed cash values in life insurance policies. And then when we look at actual results, we see stronger cash values long term. The other thing that I've seen work the best is if I select one of the 4 major mutual life insurance companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. When we look at whole life insurance policies, where people got their policies and they got them because they wanted cash value, we've seen proof of performance from those companies where I have not seen it from other companies yet. We always work on obtaining it, but I've seen it with the Big Four forever. I have not seen it with other companies. That's why I like the Big Four, because I know that I can tell a client, here's what they have actually done. I don't have to worry about the product under delivering and then the client's upset with me. Like, no, we don't want that. So the second drawback is that the cash value under delivers. How you can overcome that. One, what we hit on first, make sure the policy is designed with a minimum base premium. And then 2, make sure we're at least considering one of the 4 major mutual companies. Next, here's a big drawback and problem in the life insurance industry. Lack of transparency. You can put money into a policy and it can be the same product with the same company, and you can see 0 in the first year, like the example we started with, or you can see close to 90% of what you paid into the policy in the first year. Like, why such a difference? Has to do with how the policy is designed. And the ultimate party that controls that policy design is the life insurance agent you are working with. Now, if you're educated on how a policy can be designed, you do have a say in the matter. You can elect not to accept the policy that they show you and say, please improve the first year cash value, or I'm not proceeding with this. That's okay to say. It's your money, remember that. But the agent is the one that is ultimately designing that policy. So it does need to be transparent, meaning if I'm you, I want to know where my money is going. And here's exactly what I would look at. If we go back to those sheets we looked at, so here's an example, 2 examples of a good policy. The first one, you have $20,000 going in. Where's your premium? Here, $2,000. We've got it at 10%. Why it's at 10% is because that is as low as this insurance company will allow us to set it in the illustration software. So know the rules of the game, the insurance company's limits, and minimize it. That's in this example. And then over here, we've got a lump sum up front. The 10% minimum is based on the second year payment because they allow more up front. But that column in red is pushed as low as we could push it. That's why those numbers look better. So that's what I want transparent, just knowing exactly where my money is going. Make sense? Another item that is not transparent at all in the life insurance industry and frustrates so many people is the subject of the dividend on a life insurance policy. Point number one, 6% does not equal 6%, not with a life insurance policy. So a 6% dividend is applied to your life insurance policy if a company has a 6% dividend rate for 1 year, but what's not in the disclosure is that the dividend rate is a gross rate applied to your policy after the company's insurance expenses. So if I'm you, what I would ask is, what's my net return? Where can I see that? Some insurance companies will display this. Usually, you can ask for 2 reports from most life insurance companies, and this will be included in their illustration. The first can be the annual rate of return. Mass Mutual includes this, for example, in their cash value increase report, or the second is the internal rate of return, which will display more of the average return over time. But insurance companies will usually include this in their illustrations. You do have to ask your agent for this, as it is an optional report. It's not always going to be automatically included in the illustration. But this is an easy way to see what the net growth rate is in your policy and not go into the policy expecting a 6% dividend rate and then finding out it doesn't happen. So, for example, here's the policy we looked at, $20,000 per year going in. This company's dividend interest rate is 6.1%. When we look at this, the first year you paid in 20, what's 6.1% of 20,000? I tell you what it's not. It's not 17.5. You took a hit here. So I don't care if the dividend's 600%. If I put in 20,000 and I have 17.4 or 17.5, that's a negative 12.5% return. So I want to see what I paid in and what my cash value is, and that shows my net return. Make sense? And I can do that every year. Whenever I look at an illustration, it typically assumes what the company's current dividend interest rate is. So it's assuming 6.1% forever. That's going to change, by the way. But your net return is your net return. That is what it is actually growing by every year. Another item. Illustrations are so stinking confusing. So if you see the column annual dividend on a life insurance illustration, what are you going to think? If the dividend rate is 6%, you may think, hey, I'm going to earn 6% this year. Is that actually the case though? Let's take a look at an illustration here. When you look at a life insurance illustration, if you see the column annual dividend, what are you going to think? I would think this represents the total dividend that I'm getting from the company. However, it is not the case. So here's an example. Here's your dividend column. Not that, that's your net premium, this guy right here. End of year dividend. First year, 0. You'll see that with most life insurance policies. No dividends are paid in the first year. Next year, $864. Following year, $1,266. So let's look at the same illustration. First year cash value is $17,463. Let's look at the same illustration on Excel, and I'll show you how I like to do this. So here's the same exact policy. First year, $17,463. There's the dividend column from the life insurance illustration. First year, 0. Your growth, you lost $2,500. Here's where it gets confusing. Second year, you see $864 in dividends. This is also on your annual statement. However, if we crunch the actual math here, year 1, you're at $17,446 or $17,463. You added $20,000 to your policy, and now it's $37,747. That means you got $284 from the insurance company. That's what it actually grew by that year. So the dividend is not factoring in all of the expenses that are also being deducted from your policy. So the first 2 dividend payouts in years 2 and 3, the dividend is higher than the actual growth that you're getting, which is confusing. I hate it because it makes people feel like they're getting more money than what they're actually receiving. And then from the 4th year onward, well, now the net growth you're getting every year exceeds the dividend. So, purpose of going through this was what? The third drawback, lack of transparency. Illustrations can be extremely confusing because if I see a dividend rate of 6%, I'm going to think that I'm earning 6%. And if I see a dividend column on a life insurance illustration, I'm going to think that that represents that 6% dividend rate. It does not. It does not include the guaranteed rate. Point number 4, which is a drawback, the loan interest. Not the fact that you have to pay loan interest, but the loan interest can exceed the growth rate on a life insurance policy. And another thing here is we still run into this today where individuals have a loan outstanding on their policy and they feel that the interest rate they're paying on that loan is going back to their policy, which is not the case. Anytime we pay the loan interest, that is paid to the life insurance company. Now, what helps offset that is the fact that you continue to earn dividends and interest on the money that's outstanding in policy loans. However, the loan interest goes to the insurance company. So the drawback here really comes down to not setting expectations properly or not making it transparent. Here's often how I like to explain it. 1, the loan interest can exceed the growth rate. So what this means is that your policy might be producing a net growth rate of 4% per year. However, if you borrow against the policy, your cost to borrow is 5%. That's a negative 1% spread. So when I look at the interest rates, I'm like, all right, I feel like I'm being discouraged to borrow against my policy. Here's the other thing I would look at. If you have $100,000 in cash value, earning 4%, what does that come out to? How much money would you get? 4% of $100,000 is $4,000. Now, if you take a loan against that policy for $50,000 and the interest rate is 5%, how much interest would you pay? $2,500. So you earned $4,000 and paid $2,500, which means you had a positive spread of $1,500. So the amount that you borrow does impact the policy. If you have that same $100,000 earning 4% and you borrowed $80,000 at 5%, now all of a sudden you earned $4,000 and you paid $4,000. See the point? What helps a lot here is seeing the net numbers, meaning if you plan to borrow against your life insurance policy, one of the best things you can do is request loan illustrations before starting that policy. Ask, what would it look like if I borrow against my policy and pay it back over a certain period of time, whatever you'd like to see. But then also ask, what would it look like if I borrow against my policy, but I never pay it back at all? Or maybe I only pay interest for some time. Seeing this upfront helps so much in providing transparency and preventing buyer's remorse when it comes to understanding how loans work. This way you can see the pros, cons, what your true cost to borrow is. What we like to show is how much someone is paying in loan interest every year and compare that with what they're getting from the insurance company every year. This way we can see, am I in the black or am I in the red? Make sense? All right, so that's a potential drawback if I don't truly understand how the numbers work. And then lastly, this is a big one which I can talk about for an hour, but I'm going to go through it quickly. When it comes to sales training, there are a lot of FUD tactics. You know what that means? FUD stands for fear, uncertainty, and doubt. Meaning, I might say something to try to scare you away from getting a whole life insurance policy with a certain life insurance company. An example could be this: don't go with Mass Mutual. because they don't support infinite banking. In fact, they'll cancel your policy and refund all of your money. No, that's not true. This happened a lot because a memo was written about 2 years ago where they said we are not going to support infinite banking type sales and those types of policies. However, that memo was meant to be internal, primarily for career agents, but also brokers, and really MassMutual wants responsible selling. They saw too many cases where agents and brokers were recommending young individuals who made $60,000 per year to put the majority of their income into a life insurance policy and then borrow against the cash value to cover expenses without fully explaining the upfront hit on cash value, the fact that the loan interest exceeds the net growth rate, especially in the early years, and the fact that if the loan interest exceeds what I'm earning and I can't pay the premium, the policy could lapse. And if there's a gain on the policy, I could run into a taxable event down the road. So they wanted more responsible selling. Personally, we've never, ever had an issue with MassMutual. They have been absolutely fantastic to work with since I've been in this industry. But that is an example of FUD, fear, uncertainty, and doubt. Here's a big one. Using these tactics to try and push products and companies that pay excessively higher commissions than other companies and products. Here's what we've seen for years, and it drives me nuts. You should go with a small to medium-sized life insurance company because they support a certain concept or something like that. It's like, not if there's no proof of performance, I'm not recommending someone put their money there. It's like, no, because what you're doing here is when you look at small to medium-sized companies, if I use one, for example, I might get paid 140% commission rate instead of an 85% rate, a lot more money for me, but if there's no proof of performance and the consumer ends up with less money, what happens? They're not happy, eventually comes back to bite me. That's why we don't like to do it. That's also why I think it's FUD. Next, the power of the compounding is in the base premium. The base premium does not build cash value up front. When we looked at all of those charts earlier, did any example with a higher base premium produce more cash value short-term or long-term? No, it didn't. We won't see this happen. Sometimes in illustrations, we might see it 30 to 40 years down the road, but the problem I have with it is when we go back to actual results, I don't see it occur. What I see when I look at actual results is typically illustrations that show the highest guaranteed cash values, which are designs with minimum base premiums, end up delivering the highest actual results. See where I'm going here? Here's another one. 1-year term riders are expensive. Go with a higher base premium instead. Absolute nonsense. Here's some reasons why we hear this. Because your dividend can be used to pay for the 1-year term rider if you don't pay it. The same happens with a level term rider or a base premium. If I'm not paying my premium and I have a dividend that's going to pay it, well, it's going to pay the base premium and any term insurance rider costs. But attaching a 1-year term insurance rider is exactly what corporations do. This is what allows them to shrink the base premium as low as possible and stuff the cash value. Why would I not want to copy what corporations do? Those riders were designed for corporate sales. Then we just hear, you can't do that, or the policy will blow up. This has to do with 1-year term riders. Anyway, I'm not going to go into a rant on that. These are some potential drawbacks of getting a whole life insurance policy for cash value. The drawback here is I am scared, or tactics are used to push me into what an agent wants me to go with when it's not truly in my best interest. And then what happens in a situation like this? Eventually I find out, I regret it, I have buyer's remorse, I say whole life insurance stinks, don't do it. The industry gets a bad reputation. So key is set expectations properly, make things as transparent as possible. And if it's you looking for a policy, what I would do is exactly what you would recommend your best friend or a family member to do, which is before putting their money into a product, slow down and ask questions. Ask to see numbers. Ask to see illustrations with different life insurance companies. If someone says, oh, you don't want to see that because it doesn't look good, ask to see it anyway. That will help us see everything up front and prevent buyer's remorse. So with all of that said, I hope that you enjoyed this video. If you have any questions, please feel free to leave them in the comments. And as always, I hope this helps. Thanks so much.